Good evening and welcome to this live. My name is Saj Hussain. I'm running live on 3 platforms right now: LinkedIn, Facebook, and YouTube as well. A bit of a test, not done this before, so hopefully this will work well. So the purpose of this really is to spend the next 20 minutes, half an hour with you answering what property questions you might have. I've got some questions from last week that I haven't been able to get answered first of all, so I'll start off with those, and if you've got any questions, stick them in the comment section below. So Callie's keeping an eye on the platform for me, so he'll let me know any questions that we've got, and hopefully I'll get those answered for you too. So first of all, thank you so much for tuning in. As I said, my name is Saj Hussain. I've been in property about 14 years. I certainly don't know everything there is to know about property, but I've got a huge amount of knowledge and experience when it comes to property investing in the UK, particularly in England. And really what I'm going to do is share that knowledge and experience with you to help you get further, faster in your property journey. So I'm going to start off with the first question that we've got from Shade from Urban Vehicle Logistics. And his question is: explain a bit about crowdfunding, about funding projects or people who want to invest in property. So crowdfunding is a relatively newish platform when it comes to investing in property. And essentially the way it works is it's peer-to-peer based. That means it's individual people invest small amounts of money into that particular project. So let's say it's £100,000 raise. People might be investing, say, £1,000 each into that project, and say you've got 100 investors, maybe with £1,000 each, clubbing together for your particular type of deal. So that raises your £100,000, and it might be you're borrowing it for a period of a year, let's say 8 or 10%. Essentially, in a nutshell, that's what crowdfunding is. So it's a crowd collectively coming together to fund a project. That is a regulated activity by the FCA, Financial Conduct Authority. So that means we can't just set up one tomorrow and start doing this. We need to make sure it's compliant and it runs in the right way. There's a number of crowdfunding platforms. So Crowd Property is the one that I've used. I've just done a raise recently, £500,000 raise for phase 2 of my new build houses development that I'm doing. So it's a £500,000 raise, and it was done in less than an hour and a half, less than 90 minutes to raise those money. Now, it doesn't mean that I just jump on, put the details in, 90 minutes later the money's there. There's a little bit more to it. I've got to do the work beforehand in terms of explaining the project and how the project works, so people understand what it is, so they can get involved. So let me pause there for a moment. Khalid's looking a bit confused. Are we all good?
We're all good, all three.
Fantastic, cool. Okay, so so that's essentially what it is, and the type of projects you want to put on there. There's 2 types of funding mechanisms. One is loan-based, where people are effectively lending money for a period of time for the project. The other one is equity, where they're taking a stake in that particular investment for a long term. It's a little bit like if you were going to invest in a business. You put some money into that business, whether it's a long-term arrangement in terms of shares, and you get a reward for whatever the property, the business is generating. You share those profits, or it might be you lending money. It's very similar to crowdfunding as well. So 2 different ways you can raise money. So mine tends to be loan-based, so where I'm raising money on a loan. Once we've developed those houses, I intend to sell them and then pay the investors back their funds for that investment. As I said, there are a number of different platforms out there they can use. You can just Google property crowdfunding. You'll probably find several. Crowd Property is the one that I use, that I mentioned. So hopefully that makes sense, that helps. In terms of the type of projects you would do that for, it's a little bit like what type of project you might say use bridging finance or traditional bank finance for. It'll be a project where the lenders can effectively get first charge on the property, so you haven't got any other debt against it, where you could use development finance, as I mentioned, bridging. All these type of projects you can use crowdfunding for to raise money. And if you want a contact or connection with somebody to talk about a project, just send me a message and I can connect you with somebody to talk to you about your project. So hopefully that's useful, Shay. Thank you for that question. I'm going to jump on to the second question I've got, which is from Matthew Ibinson of JIH Property Investments. And his question is: where's the best place to find business network events based in London? Are you open to anybody in terms of I'm not entirely sure what you mean by that, Matthew, but your reason is to meet investors. So essentially what Matthew is asking is places where he can go and meet potential investors, I'm assuming, to come and invest in property with him, that are business networks. So when it comes to raising money, and you're out networking for your particular property project that you might have, is thinking about who might be the right type of investor for that project. So and where you can look. So one of my favorite places is networking. I run a networking event, so some of these are from my events, the video scrolls on in the background, and the network meeting I run on a monthly basis, which is on the third Tuesday in Birmingham. Make sure if you're not already book onto that. We don't meet in December and August, so our next meeting in a couple of weeks' time is the last one for the year. In fact, the last one of the decade. So make sure you're booked onto that. Network meetings, when it comes to the type of network meetings to go to when you're looking to raise money, personally my preference is property. Well, why property? Well, actually, if we look at the contrast of business ones, I'm not saying business ones don't work, I'm just talking about preference. When I go to a business networking event and I'm speaking to somebody about what I do and about investing in property, and I'm talking to them about maybe getting involved with me investing in projects that I'm running right now, first of all, I have to sell the concept of them investing with me, them investing in a particular property with me. But before that, I've got to sell them into the idea of property investing is a good thing to do, right? Compare that to a property networking event. If you're at a property networking event, the people in the room are already aware of property and the opportunities that exist within property. They're there because they're interested in property, right? So I don't have to sell the idea of investing in property. They already get that. We can focus on building relationship, talking about whether we might be able to do business together. Whereas at a business networking event, first hurdle is I've got to sell the idea of investing in property. So let's just park all that to the side for the moment, and let's say you're looking for people that you want to meet at business networking events. So I'm sure there's probably many more in London than there is in Birmingham, where I'm based. So Birmingham, for example, the ones that come to mind straight away is you've got your for networking and my mind's gone blank. What's the other big breakfast network meeting? BNI.
BNI.
That's the one. BNI. So you've got BNI, for networking, you've got a number of other ones as well, business networking events that you can go to. I just Google business networking events. There might be breakfast ones, there might be afternoon ones, or there might be evening dinner ones, but there's many in Birmingham that you can just go along to, meet people and chat to. Now, here's the thing with networking. I've been running networking events for a long time, particularly property networking events. And sometimes I'll meet somebody, let's say a mortgage broker, for example. I've used this particular example of someone, I'm not going to mention who it is, a mortgage broker came along to one of my events once and said, oh, I hadn't seen him for a long time, I knew he was a mortgage broker, I invited him, come along, look, I've got a room full of property investors, they're all property people. You know, I'm sure you can help some of them with your knowledge and experience around mortgages, and you can probably pick up some business as well, right? So he'd come along to the meeting, or let's say he came along once to that meeting, and then when we spoke about it afterwards, I said, how did you get on? He goes, oh, it was really good, it's a good meeting, but you know, I don't think I'm going to be coming back. And I said, why is that? I don't get it. And he said, well, I didn't pick up any business. And he didn't get the idea that actually with networking, it doesn't mean you're going to meet somebody and do business with them immediately. It's an introduction, it's a connection, it's a start of a relationship, and that's the thing to think about. So when we're thinking about what networking events we're going to, sometimes people flutter around between I'll try this one, I'll try that one, and this one, and that's how they'll do it. You know, there can be some benefit in that, but if I was going to networking events, what I'd try and do is get to different networking events, but get to them more than once. So that you can build a little bit of relationship, you can start becoming a little bit of a regular, and that's how you start building connections. And not only then will you be meeting people at that event that you might be able to talk to about business, but you'll find you'll meet other people through them because they'll start recommending you and referring you to other people. But if you're just starting out, you might go out to various different meetings at least once just to get a flavour for them, see which ones you feel that you can probably add value to, because remember, it's about you giving first rather than you taking, and think about where you can add value to those. Just got some more questions. In terms of adding some value, and then thinking about where you think the ones that you may pick up more business from. Because here's the thing, if you're looking to raise money for property, you're really probably looking for businesses that are mature, been running for a while, or sizable businesses, rather than micro businesses, small startups, solopreneurs, who may not necessarily have the funds. I'm making some assumptions here, but may not necessarily have the funds that you're looking for investment. So if it's investment that you're looking for, think about where those more mature businesses and the owners, managers of those businesses may be based. So Matthew, I hope you found that useful. I hope that answers your question. If not, just ping me another message, and I'm more than happy to add some further content to there for you. So the next question I've got is from Mitesh Palmer on Facebook. His question is, can you cover EDC, which is exchange delayed completion? When is SDLT paid? When is money exchanged with a vendor? So covering money exchange on this type of deal. So essentially, for those that may not be familiar with what it is, EDC is an exchange with delayed completion. And when you think about a traditional purchase of a property and your solicitor does the conveyancing, once the legal work is done and everybody's good to go, the solicitor talk about exchanging contracts. Exchanging contracts is that commitment where you as the buyer have committed to buy that property, the seller has committed to sell you the property, and you agree a date in terms of when keys will exchange and monies will exchange hands. That might be later that same day, it might be a few days later, it might be 2 weeks later, it might be in a month's time. Typically, it tends to be something like that when you're purchasing a property that way. Let's say at auction, for example, if you're in an auction room, you stick your hand up, you purchase a property, the hammer goes down, you've purchased that property. They say, well, actually, you've exchanged contracts at that point. You're legally committed to buy it, and they give you 28 days to complete it. So your delayed completion is 28 days in that particular example. Now, when people talk about creative deals, or where they tend to use the term EDC, is when you can stretch out that completion period much, much longer. So I have one, I think it's about 21 years, I'm not sure exactly, about 21 years I've got as a delayed completion. You think 21 years? That makes no sense. How have you exchanged contracts and delayed it for 21 years? And the way I've done that is I've completed on the exchange part of the process, where we've exchanged contracts and I've got keys and I've got access to the property, but we've delayed the completion part in terms of when I pay the balance of those funds until 21 years, because effectively what I'm doing, I'm servicing the debt that's already on that property, which is the mortgage payments of the vendor for that particular property. And within that 21 years time frame, I'll purchase it when I feel the time is right for me, in terms of the market is right, mortgage products that are suitable are available to do that particular purchase. So first of all, let's talk about the difference between, let's say, an option agreement and a delayed completion. With quite often with option agreements, people tend to do those where you have a right to be able to purchase something, but you're not obligated. You're not committed to have to buy it. You can purchase it, but you don't have to. With exchange and delayed completion, you're legally committing to completing on that transaction. There's no back out. Now, there's a few caveats, there's a few ways you can actually get around it, but I won't go into those technicalities right now. Generally speaking, an option agreement, you have the right to purchase it, but you're not obligated to. With an exchange and delayed completion, you are committing to see all the way through to completion, however long that gap might be. As I said, it might be a few days, it could be weeks, it could be months, it could be many, many years in terms of how that's done. Now, Mitesh has raised an important point about stamp duty, SDLT, when that becomes payable. So there's a thing called substantial performance needs to occur. What that essentially means is where you as the buyer take benefit from that property, that's when the stamp duty is payable. Sometimes people talk about stamp duty is not payable on option agreements and is payable on exchange and delayed completions. First of all, I'm not a tax expert, I'm just giving you my guidance and my experience on doing these type of transactions. It can be quite complex, but as far as I understand and the research that I've done, and many people I've spoken about this and I've done many of these type of deals, is that stamp duty has to be paid when substantial performance occurs, when you take benefit of the property. So let's say I'm purchasing a property where I exchange contracts and I get keys to that property and I can start putting tenants in it and renting it out. I'm now getting benefit from that property, so I have to pay stamp duty at that point, at the point of exchange, whereas typically stamp duty is paid once a transaction is completed. So people will sometimes try and structure deals as an option agreement so they don't have to pay stamp duty. I'd say that's not the only reason to do that. You need to just get some advice around, is that the right way to do it? Because stamp duty can be quite complex. So tax generally can be quite complex. Even though the tax man says tax doesn't have to be taxing, right? So it's really important that you've got the right advice on that. So stamp duty needs to be paid when substantial performance occurs. So let me just have a look what the second part of that question is. When is the money exchange with the vendor? Well, you have to pay some money to make the contract legal. Now, you may have heard the term buy a house for £1. The idea is effectively that you have to pay a minimum of £1 to make the contract legal, to then actually move forward with that particular contract. In fact, it doesn't have to be £1, it could be a penny, it could be less, just people talk about it being £1. And with these type of transactions, normally you may pay £1 just to make it legal, and you might have the balance paid later. The reality is, all these things are negotiable. You negotiate them with your vendor, you agree the structure in terms of how you're going to do it. The trick is, you don't go to see a vendor with a view to try and do a lease option or do an exchange with date completion. What you do is go to see the vendor with a view of how can I help this particular vendor resolve whatever problems, pains, issues they have right now around their property, and then how can you package a solution around that. This is where you look in your toolbox and say, maybe I could use exchange with delayed completion, maybe it could be a lease option or some other type of creative transaction. So it's not forcing the deal to fit an EDC, it's just using an EDC when the opportunity presents itself that it might be right. So let me give an example of when this could work. Let's say, I'll give you an example of one of the ones that I've done, the one I mentioned actually with 21 years left on it. So this particular property was, the vendor contacted me through one of my adverts in terms of I buy houses. Or I spoke to them, they had quite a lot of debt on the property, which meant there wasn't enough equity for them to be able to sell it on the open market, which they've been trying for a while. This was a few years ago while the market was still a little bit suppressed. So they couldn't sell the property because they owed more on the property than the property was worth. So effectively, the only way a sale was going to complete, I'll use some arbitrary figures because I can't remember the exact numbers. Let's say they've got the property advertised for £100,000, that's what it's worth, but their debt on it is £110,000. That means the only way that transaction can complete is if they put their hand in their pocket, pull out £10,000, put it into the transaction to clear the 110 grand of debt. Now, they're not in a position to do that, and that's not something they wanted to do. But at the same time, there's a partner, it was a husband and wife, and they'd gone through a divorce. The property had been allocated to the wife, and she didn't want to live there. She had a lot of bad memories in it, and she wanted to move on with her life. So what we agreed is that I'd take on the property, I'd service the debt on it each month, and then I'd effectively just let it out. Now, I didn't want to purchase it right now because there's no equity in it. There's no benefit in me doing that. There was also the mortgage on it is only about 120. It's a very small amount. I can't remember the exact amount. I don't want to guess and give you wrong information. It's around 110, 120 pounds the mortgage payment each month. And I rent that property out, I think it's about £550. So quite a big profit margin in between just taking on a bog standard single family house, paying the mortgage each month and just renting it out as a single let and making a nice profit on that. Now, first of all, I wanted to make sure that that property I can control for the long term. The vendor wanted to make sure that I'm not going to back out of this, I'm committing to this, I'm going to do this. I've also spent money on the house to make it a little bit nicer as well to make sure we're getting very good rent from the property. But the option agreement would have meant that I could have backed out. So there wasn't enough certainty for the vendor. The vendor wanted certainty, and this way the exchange of contracts gave them the certainty that I would complete on this transaction at some point in the future. Really what they were looking for, to wash their hands of this and be able to walk away and not have to worry about this property anymore. So ultimately what I was offering them was the certainty that they can walk away and I'll deal with this going forward, which I have been doing. I've had that one for a few years, and at some point in the future, as I said, we'll complete on the purchase. So the benefit of me doing that means I'm making a cash flow each month. I've not put any money down up front. It was just a little bit of legals, a few £100 of repairs and stuff, just light at the beginning. I've done a little bit more work on the property since, but it makes a nice cash flow each month. And when the property prices start rising, and I think right now it's probably got a little bit of equity in it, we've gone past the negative equity stage. At some point when I think there's 20-30% of equity in it, I'll probably take on a bridging loan and complete on that transaction. and then refinance it onto a traditional buy-to-let mortgage. So that's an example of how that can be used. How are we doing for time? I think we're okay for a few minutes. So Mitesh, let me know if that's answered your question. I want to make sure I've kind of covered all that off. Excellent. So let's see if we can get one more question in before we finish. So Nadim Ali from Acquisition Specialist in Milton Keynes has got a question. What would you say there is a big demand for rent-to-rents as it's an initial investment is low? I think Nadim, you're essentially saying is rent-to-rents a viable thing to look at, particularly as it doesn't require a lot of money to get into it. So when you're starting out in property, there's many factors that you have to consider. How much time you have, how much experience, how much access you have to money, contacts, knowledge, where you are in the country, timing of property cycles. All these things have an impact on what strategy might be the right one for you and be able to deliver on that and making it work. Just because you see somebody else doing an amazing job at one strategy, it doesn't mean that strategy is going to be right for you. It doesn't mean that strategy is going to fit you like a glove. What you have to do is look at what's required to make that work based on where I'm living with the resources I have access to. Now, often rent-to-rent is a good strategy that people start with, and I think the important thing to remember with rent-to-rent before you even consider it, that it's not something that allows you to build a property portfolio. It's not a portfolio building. It's not an asset building strategy. It's effectively a cash flow strategy. And for that reason, you should treat it as a stepping stone. So what it means is you use that strategy at the beginning to build up a certain amount of income. Often people will use rent-to-rents as a strategy to get started, to get a certain amount of income built up so they can give up their day job. So they no longer have to work for somebody else, and now they have time freedom. So you've got a certain amount of money coming in from your property that you manage in this way under rent-to-rents. You can give up your day job, you've got your time back. But then at that point, I think it's important to try systemizing that business and start looking as soon as you possibly can to acquiring and controlling assets for the long term rather than just managing property. Because let's face it, as when you're running a rent-to-rent strategy, really what you're doing is you're a letting agent. You're taking on a property from somebody, an owner of that property, and then you're dividing up into its components, i.e. rooms that you're letting individually, say rent to HMO if that's what you're doing. And then you're collecting rent from each of those rooms. You're paying the running costs each month, the bills, etc. You're paying the landlord the fee that you agreed with them, and you're making some cash flow. Now, if you do this strategy well, really you should be making about £800 to £1,000 a month for running rent-to-rent properties. My target's always been a minimum of £1,000 a month for the rent-to-rents I used to run. I was teaching rent-to-rent strategy about 7 years ago, probably coming on, about 7 years ago. Now, the strategy's evolved a little bit in the sense that people are much more aware of what it is. Landlords are much more demanding from potential people, from potential rent-to-renters. So let me explain what I mean by that. One of the techniques to get hold of properties to run as rent-to-rent is to get hold of your local HMO license register, i.e. the list of all the licensed houses in the area, and then you can contact those owners and say, hey, look, I'm looking to either rent a property for the long term in this particular area, or I'm happy to maybe look at a purchase as well. Effectively, what you're looking for is a property you can take on for the long term that you can manage, which belongs to somebody else. Now, what that would do initially, you'd start a conversation with them, you'd talk to them about what they want, you'd work out what is it that they're asking for, what's the condition of the property, can you make it a bit nicer, can you maybe remarket it, for instance, was it a student let before, can you turn it into a professional let, you just repurpose it for a different audience, can you make it a bit nicer so you can charge a higher rent than what the landlord is actually looking for from you. You'd work out if you can make some profit from it essentially, right? And then you take that property on, you'd run it and you'd pay the landlord. That's how essentially many people are finding rent rents. And of course, the other option is to go to letting agents and find the properties that way. Now, when you're sending out letters, you're speaking to the landlord, and the landlord saying, well, why should I give the property to you? This is the sixth letter I've had this month. Because many people are following the strategy, but they don't recognize actually it's changed. So your language patterns need to change, how you approach things need to be changed. So you need to adapt as the market adapts and as the strategies adapt. So coming back to your question, Nadim, it's absolutely a good strategy to use to get started. It's not for everybody, it's quite time intensive, you have to do a lot of work, but hey, the rewards are great as well. And you should be typically aiming for about £800 to £1,000 is my view. Some people are quite happy doing £500, or even I hear people sometimes talking about £100 a room. So let's say you've got a 6-bedroom house, you're creating £100 profit minimum from each room, so say £600 profit. So you find a figure that you're happy with. I think because the amount of work involved in that you want to make it really profitable. And then think about it as a stepping stone strategy. So you get to a certain level, you set that target when you start, and you say, right, when I get to that point, I need to review and reflect on what is it we've already done, what is it we've built, and how do we want to move forward. And as soon as you can, start looking at how you can then own property. Because remember, what happens with property? Why do we get into property? We get into property for income and for capital growth. Income is what we're talking about right now, the cash flow we create each month. But the true wealth is in the long-term growth of the value of that property. Now, if you're doing a rent-to-rent, that increase in value is not yours. That belongs to the landlord. The landlord's the one that's benefit from that long-term growth. You're not doing that. So use it in the short term as a stepping stone strategy to get you started. But in the long term, think about as soon as you can, as soon as you have the time freedom, the cash flow freedom, to think about how you can start acquiring property. So Nadim, hopefully that's answered your question. And let me know if you've got any further questions you want to explore. Hopefully next week, Monday, again at 8:30, we'll run another live on Facebook, LinkedIn and YouTube. As long as the tech works, I look forward to seeing you again very soon.